Guys, welcome back. Today we are going to solve a problem from DT. Three concepts we are going to cover in this video, which is thin capitalization. Short question will be there in your in our question paper for June 26, and also another concept which is from DTAA unilateral. Okay, one unique transaction is there that we'll discuss, and then tax planning using tax planning under FM method. Okay, this FM method problem has been I have recently come across with the practice test papers from the ICMA. So might be in a focus area for ICMA. So we'll discuss that also in this problem. Okay. So now thin capitalization. Why thin capitalization? Because when a foreign associate enterprise giving a loan to Indian associate enterprise. Okay, the foreign associate enterprise can also raise their equity. No, they can give a money also in terms of equity. But if they are giving equity, they will be getting dividend. Dividend is non-taxable. But if they are giving us a loan, interest is taxable expense. No, so instead of giving us a equity, they will be giving us a loan to the associate enterprise in the India. So in India, they'll be paying more interest. That will be actually unfavor the tax department. So they have brought down the concept which is 94B thin capitalization. Thin capitalization says that if you are paying more than 1 crore interest, um, you will be compute the interest allowable interest under provisions given in the 94B. That is nothing but 30% of EBITDA. Okay, so we have to check whether the actual interest we deducted and 30%, whichever is lower is the deductible interest. Okay, as per 94B. So this is the concept. With this idea we'll just solve this problem. Okay, now thin capital X Limited is an Indian company, borrowed 50 crores from Y Limited. Okay, an American company at an interest rate of 8%. Okay, they haven't said whether it is AE or whether it is AE or not. They haven't given any information so far here. We'll see in the upcoming part. Okay, net profit has been given after tax, which is after interest income tax. So, okay, we have to take up this 1.4 crore income tax, depreciation, 0.5 crore dividend. Okay, now they have said that book value of assets is 98 crore, book value of assets is 99 crore. Okay, if okay, they are saying that deemed associate enterprise provision is coming here. If 50% of loan 50% of fixed assets as loan, they are deemed associate enterprises. Okay, then 98% into 50% is how much? 49 crore. Okay, a small correction. This is more than or equal to 51% of fixed assets given as loan. Okay, now two scenarios they have given: 98 crores, 99 crores. Okay, 98 crores into 51%, which is 49.98, not deemed associate enterprise, because this is this is DAE, because they have given 50 crore loan. No, so deemed associate, they have to give only below 49 crore 49.98 crore, but they have given 50 crore. So deemed associate enterprise attract here. But when it comes to 99 crore, 51% is 50.49. So we have given the lesser than our loan is lesser than book value of assets, 51% of book value of assets. So not DAE and not deemed associate enterprise here. So on this problems we have to solve this problem. Okay, What's the EBITDA? 5 crore. 5 crore plus 1.5 plus 1 plus 0.5 plus interest how much? 50 crore into 8 percentage. Any dates have been given, so if your dates now we have to as per the dates we have to apportion the interest. Okay, so 4 crore is the interest. Total is 5 plus 1.5 plus 1 plus 0.5 plus 4, which is 12 crore. EBITDA is 12 crore in both the areas. Then minus 94B interest allowed 30% of EBITDA. Well, into 30%, which is 3.6 crore. Then actual interest, which is how much? 4 crore. Okay, a disallowed portion is 0.4 crore. Okay, in case of DAE we have to deduct the 3.6 crore only as a interest, allowable interest. In case of DAE 3.6 crore. In case of not DAE, entire 4 crore we can deduct. So that is, they are not DAE, no. So this is the concept. In the question they have asked us to find out the taxable profits. Let's quickly find out the taxable profits. Computation of taxable profit. Okay, DAE, not DAE. EBITDA is 12 crore, 12 crore. But the thing is, in the question they have deducted dividend also. Dividend is non-deductible. And they have deducted income tax also. Income tax also we are going to calculate the taxable profits, so taxable income only. So we are not taking that also. So depreciation is how much? 1 crore minus allowable interest, which is for DAE 3.6 crore, for not DAE 4 crore. So total taxable profits is 12 minus 1 minus 3.6, which is 7.4 crore is the taxable profits in case of DAE. 12 minus 1 minus 4, which is 7 crore in case of not DAE. Okay, so that's it. The problem is over. I hope you guys have understood this problem. The next problem is DTAA. DTAA is simple. First we have to check what's the age. Age is more than 60. Then 3 lakh is the 3 lakh is the basic exemption limit. Okay, now I've said that Indian resident in India furnishes you the particulars of income for the previous year. Okay, he earned income in country M, and okay, now no DTAA means unilateral, right? And also, and the thing is, income from house property in country M, foreign IFHP, foreign. Business income in India, PGBP. They have directly said the IFHP. If they are receiving giving rental now, we have to find out the IFHP. But they have directly given the IFHP, so we can directly take this is Indian income. IFOS dividend, which is foreign income. Royalty income, which is IFOS, which is foreign income. Business income, which is PGBP, foreign income. Yes. Then IFHP, which is Indian income. This is deduction, 100% deduction allowed for pre-em fund. And then medical expenses for his mother under ETG donations. Medical expenses for aged mother who is 85 no senior citizens. Basic 25,000 plus senior citizen deduction, which is 25,000, total 50,000 deduction is allowed. Then they have given that the tax is 20% for country M, and also they have asked us to see the note no for royalty. Disputed royalty income in country M, but paid the tax on that income is income in June 25 after the appeal was decided by the appellate authority. Okay. The concessional rate they have charged is 15%. 15% charged. Other than this, every other foreign income is taxed at 20%. 20%. Right? Yes. Okay. Any other things? Okay. They have asked us to find out the tax liability under normal tax regime. So we'll slowly solve this problem. Okay. Particulars rupees. What's the IFHP? 2,50,000. 2,50,000 plus 5 lakhs, which is 7,50,000. Okay, including foreign. Then PGBP. What's the PGBP? 8 lakh. Then 2 lakh, which is 10 lakh. Then comes IFOs. 1 lakh plus 4 lakh. Other than that, yes, nothing. Okay, 5 lakh. Total 22 lakh 50,000 is the gross total income, minus 80D we have, which is 50,000. 80G we have, which is also 50,000. Take that, 21 lakh 50,000. Okay, this is the net total income, minus, sorry, not minus, you have to calculate, compute tax liability. Basic exemption limit is 3 lakh, 5 lakh, 10,000, 5 lakh to 10 lakh, 1 lakh, more than 10 lakh, which is 11,000, sorry, 11 lakh 50,000 into 30%, which is 3 lakh 45,000 plus 4%, which is 4 lakh 73,200 is the tax liability. Okay, so we found out the tax liability. Now what's the tax rate in India? 47 lakh 4 lakh 73,200 divisible by 21 lakh 50,000, the net net taxable income, no? So 22% it is coming. So 22% is the Indian tax rate, but foreign tax rate is 20%. Whichever is lower, 20%. Which are all the incomes comes under 20%? IFHP 2,50,000. Okay, 2,50,000 plus IFO was 1 lakh. Okay, then PGBP 2 lakh, which is 5,50,000. So 5,50,000 is the doubly taxed income. Okay, so we have to give a deduction, we have to give a relief at 20%, which is 1,10,000, right? And also we have another income which is taxed at 15%. Okay, if it is 15% means India 22%, foreign 15%, no, whichever is lower 15%. Doubly taxed is 4 lakhs. So 4 lakh into 15%, which is 60,000. So 1,70,000 is the relief. Tax liability, this part, minus relief under section 91, which is 1,70,000. Deduct that, we'll get rupees 3,03,200 as the net tax liability. Yes, this is the answer. Okay, now this is how we have to work out. We'll go to the last problem, which is from tax planning FM question. Okay, now what they are saying is the company wants to acquire an asset of asset costing 1 lakh. They have two options: buying an asset, loan repayable in 5 installments, which is 20 lakhs, which is principal, plus 14% interest. Okay. Second option is leasing the asset. So annual lease rental charges 5% up to 5 years, 1% processing fee. Okay, they have internal rate of return, they have given 10%, and also they have given the present value factors. Rate of depreciation 15%, tax rate 13%, the tax rate 33.22%. The thing is, what we have to do is, which option is better option, whether we can lease or we can buy. Lease or buy decision we are going to make under this. The thing is just we'll align all the things. Asset cost rupees 1 lakh. Okay, then loan principal, which is 20,000 per year, interest 14%. Okay, first option. Second option, lease per year, which is rupees 30%, processing fee 1% per 1% in the first year itself. Okay, first year only. Okay, and depreciation they have given. The thing is, we have to prepare a table. Step 1, year, opening loan amount, interest, principal, then comes closing loan. Okay, and then we have to add the depreciation, and then net outflow. I think yes, net outflow. Sorry, before that we have to calculate the tax benefit. Okay, and then net outflow, PV factor, PV of net outflow. This is the decision making factor. Okay, now this is how we are going to arrange this question. Okay, now year 1, 2, 3, 4, 5. What's the opening loan is? Opening loan is 1 lakh. What's the interest for the first period? 14,000, right, at 14%. Principal, they have said they are paying 20,000 standard principal every year, paying off in 5 years. So 80,000, 60,000, 40,000, 20,000 will become 0 at the end. Okay, so 80,000 into 14%, 11,200. Then 60,000 into 14%, 8,400. 40,000 into 14%, 600. 20,000 into 14%, which is 2,000. Right. Okay, now depreciation we have to calculate. No, depreciation working note, first year 1 lakh. WD basis will calculate, because mostly we'll be using WDV in predominant places, right? 1 lakh into 15% is the depreciation rate. 15% means 15,000. We'll use the another method, 85% we'll use, because the net off is 85%. So 85,000 it will come. Again 85% into 15%. 85% into 85,000, 72,250. 72,000 into 85%, 61,413 into 85%, 52,201 into 85%, 44,370. Difference we'll calculate. 15,000 is the difference. 85,000 minus 72,250. 12,750. 72,250 minus 61,413, which is 10,837. Then 61,413 minus 52,01, which is 9,212. Then 52,201 minus 44,370, which is 77,831. Just to plug these values here. 15,000 of 12,750, 10,837, 9,212, 7,831. Okay, what we have to do is we have to calculate this interest and depreciation portion. We have to calculate the tax benefit at 33.33%. Okay, we'll take this off. We'll calculate the tax benefit amount and the tax rate, and we'll calculate the benefit. Okay. Tax deductible amount. Okay, total this tax rate, tax benefit. Okay, due to space constraint we'll use this. Okay, 14,000 plus 15,000, which is 19,000. Then 11,200 plus 11,200 plus 12,750, which is 23,950. 8,400 plus 10,837, which is 19,237 plus 5,600 plus 9,212, which is 14,812. Then 2,800 plus 7,831, which is 10,631. Tax rate is 33.3322 into standard 19,000, which is 6,312. 23,950, which is 7,956. 19,237, 6,391, 14,812, 4,921, 3,532. Yes, we got all the tax benefits values. Now we have to check what's the outflow and what's the tax benefit we got. We have to calculate the net outflow. Okay, we'll set aside this. Okay, now what's the cash outflow we have here? Total cash outflow is interest plus principal. Okay, now what's the cash inflow here? Tax benefit. So we are going to net off and calculate the net cash flow. Okay, cash outflow, cash inflow, which is tax benefit. Cash outflow is 34,000 here. 1 2 3 4 5. Cash outflow is 34,000. 31,200. 28,400. Then 25,600. Then 22,800 is the cash outflow. What's the cash inflow? 63127956 cash inflow in terms of tax benefit. Okay, 63914921535332. Okay, what's the net cash flow? Net cash flow is 34,000 minus 6312 27,688, 31,200 minus 7956, which is 23,244, 28,400 minus 6,391, which is 22,009, 25,600 minus 4,921, which is 20,679, 22,800 minus 3,532, which is 19,269, 268. Okay, we have got the, yes, this is 29,000. I made a mistake. Okay, 29,000 into 33.22%, right? Which is 9634. Other than that, everything is okay. 9634. Deduct that 34,000 minus 9634, which is 24,366. PV factor. Okay, PV factor is how much? 0.909, 0.826, 0.791, 0.683, 0.621. PV of net cash flow is 24366 into 0.909, which is 22,149. 23244 into 0.826, which is 19,200. Then 22009 into 0.751, which is 16,529. 20,679 into 0.683, which is 14,124. 19,268 into 0.621, which is 11,965. Total is up 22,149 plus 19,200 plus 16529 plus 14,124 plus 11,965, which is 83,967. Okay, this is the present value of cash outflows of in case we are buying the asset. Okay, what if we are selling what we are leasing the asset? Leasing the asset means very simple. Cash flows will be 1% of 1% processing fee, so 1,000 in the year one. Year one we will be paying 1 2 3 4 5 30,000 standard. Here the cash inflow is a tax benefit. For all this amount, we'll be getting the tax benefit. Okay, 0.3322. So 1,000 into 0.3322 into 1,000, 332, 30,000. 9966, 9966, 9966, 9966, 9966. Net cash outflow is 1,000 minus 332, which is 668. 30,000 minus 9966, which is 20,034. Okay, so first year is what? 668. 668 into 0.909, which is 607. Then we can use the PVAF factor, which is total this, if it, the total all these things up, and this will be 1.1. Yes, plus 3.791. So 20,034 into 3.571, which is 71,541 plus 607, which is 72. 1 minute. This is okay. This comes to 3.79. Let me check 1 minute. I've used IRR is 10% only now. Just 10% only. And this will be 1.1. 2, 3, 4, 5. .79 only. We have taken the wrong value. Okay, we have to correct that again. 20,034 into 3.79, which is 75 929. Total this up with 607. We'll get the value. We get the amount outflow. Present value of net outflow is 76,536. Okay, so see which cash outflow is lower. Least we have to lease them. So that is the least now suggestible option for us to use the machine. So this is how we have to calculate this is how we have to use the tax planning in the DT. So we'll solve another type of questions in the evening. Okay, thank you.